Hey everybody, welcome back to Dividend Stockpile. Today we're going to be talking about a critical tool that all dividend investors should have in their arsenal, a dividend stock watch list. So you might be wondering, if I already have a quality dividend stock portfolio, why do I need a watch list? Well, a watch list will allow you to pre-identify opportunities that you might want to add to your portfolio mix. It allows you to take advantage of ups and downs in the market, understand when a stock is undervalued, and it also allows you to diversify your portfolio. If you're looking to add stocks in the future, you don't have to do new research every time you want to think about adding new money. With the watch list, you already have pre-selected stocks that you're looking at, and when the opportunity is right, you can go ahead and act on that opportunity. If you're following along in our How to Build a Dividend Stock Portfolio from Scratch series, one of the stocks on this watch list I'll be adding to that portfolio over the next week. I'll be talking in depth about that particular stock and why I chose it in the next episode of that series. So make sure you're subscribed, stay tuned, and take a look at the next episode to understand which stock within this watch list I decided to purchase for my portfolio. But before we go into my watch list, I wanted to talk about the benefits and how to set up your own dividend stock portfolio watch list. So stay tuned. A watch list is more than just a list of stocks you're interested in. It's a strategic tool that allows you to monitor opportunities without impulsively buying. Here's why it's essential. Market conditions can shift fast, bringing some of your top companies down to attractive price levels. By monitoring specific stocks, you'll be ready to act quickly when there's a buying opportunity. When you keep track of your target stocks, you're not starting from scratch every time you want to buy. You have historical price patterns, yield levels, and dividend payment schedules ready, which speeds up decision making. A well-maintained watch list allows you to strategically plan the growth of your dividend portfolio by focusing on stocks that align with your goals and risk tolerance. This is especially important for sectors you might want more exposure to. And a watch list allows you to plan and manage your portfolio better. You can see how potential stocks might fit into your current holdings and help you diversify effectively. Let's break down the specific benefits of keeping a dividend stock watch list. Each benefit is another reason to get one set up and ready for your next investment move. A watch list helps you stay tuned to market trends and sector shifts, so you can catch on early to potential growth or dividend boosts in sectors like tech, healthcare, or utilities. Having a watch list instills discipline. Instead of jumping on hot trends, you are sticking to stocks that you have pre-vetted for quality and dividend reliability. Dividend growth is key for income-focused investors. A watch list can include stocks with strong track records of dividend increases. This way, you can follow companies that regularly raise their dividends, helping you grow your income over time. And when you have extra capital or dividends to reinvest, your watch list serves as a go-to, helping you reinvest in companies that match your long-term strategy. Now, let's go over some steps to build a dividend stock watch list that's truly useful. First, consider what matters most to you in a dividend stock. This might include yield, dividend growth rate, payout ratio, sector, and past performance. You can use a simple spreadsheet, a dedicated investment app, or even a brokerage watch list. The important part is to keep your watch list updated and organized by priority or your sectors. I use Google Sheets, which I'll show in a few minutes. Markets are always changing. Schedule a time each month to review your watch list. Remove any stocks that no longer meet your criteria, and add any new ones that might be of interest. Rating stocks based on their yield, dividend growth, payout ratio, or other criteria can help prioritize which ones are the most appealing buys. Create a system that allows you to quickly identify your best opportunities. Now, let's take a look at my own dividend stock watch list. All right, so here we are inside the dividend stockpile watch list. For those who are following along with our series on how to build a dividend stock portfolio from scratch, you know that I have 11 total holdings in that account right now, and eventually I'm looking to increase it to 20 holdings. I will be adding $600 every 2 weeks to this particular portfolio. So as time goes on and I add more money to the account, I'm going to be expanding my list of companies held from the 11 to up to 20. And so I've established this watch list of quality companies that I'd be happy to add to the portfolio. I'm going to be focused on diversification and making sure that I have a balanced portfolio, but I'm also looking for a good value, a historical good total return, a great dividend and great dividend growth, and a low payout ratio that can help support the dividend. So looking at the watch list, you can see the different columns. We have the symbol, the name, the industry, the price, 52-week high and 52-week low, percentage change today, the percentage off the 52-week high. While this is not a valuation-focused portfolio, it is important to understand where the company is compared to historical numbers and with the market in general. So I go ahead and track how it's doing compared to this 52-week high. Then we look at the valuation. So we're looking at the price to earnings currently, as well as the historical price to earnings. If the number is lower, that means it's potentially undervalued compared to its own historical average. As I mentioned, we want a portfolio that has a beta of less than the market, meaning it's less volatile overall than the market. So we're looking at a total portfolio beta of under 1. So we went ahead and highlighted that. And then we want it to be a total return portfolio. This is a long-term portfolio, so in addition to the dividend, we want capital appreciation, and the total return shows how they're doing over the last 5 years. Then we move on to some of the dividend metrics. So we have the current dividend dollar amount, as well as the dividend payout ratio, the current dividend yield compared to the historical dividend yield, the average dividend growth over the last 5 years, and then we have a column for the Chowder rule. And for those who aren't familiar, if a dividend company is currently paying less than a 3% yield, we're looking for a Chowder rule of 15, meaning that between the current dividend and the 5-year dividend growth, it needs to be equal to 15. If the current yield is over 3%, we're looking for a Chowder rule of 12. All right, so that covers that. And then we also want to look at the total number of years of dividend growth. While there's no guarantee that a company will continue paying the dividend just because they've paid it in the past, it does give a good history of how the company has survived different market cycles, different shocks to the industry, and it does show that they have a commitment to paying the dividend. So it's just one extra thing I look at. It's not the sole thing, but it is nice to see, some of these companies are paying 20, 25, even 50 or 60 years. So it's nice just to get a sense on how long they've been paying a dividend and how consistent they've been. Okay, so with all that, I went ahead and filtered my watch list based on the industry. So we're going to touch on each industry and which companies I'm tracking within. And then at the end, I will go ahead and scroll through each of the details of each of the companies so you can see how they match up. And as I mentioned before, I am going to be adding one of these companies to the portfolio that I mentioned that we talk about on this series of how to build a dividend portfolio from scratch. And so in the next episode of that, I'll tell you which one I've added to my portfolio, and we'll go into details of that particular company. So with that being said, let's start off with consumer cyclical. The companies on my watch list is Target, McDonald's, and Tractor Supply Company. They should be familiar, but Tractor Supply is a retailer that does farm and agricultural goods, as well as things like mowers and tractors and things like that. All right, so moving on to the consumer defensive, we have 5 names on the list. We have Procter & Gamble, Archer Daniels Midland, PepsiCo, McCormick & Company, and Cisco. I'm not a huge fan of banks, but I do have 3 on my list for financials. So we have Bank OZK, which is a regional bank. We have the Federal Agricultural Mortgage Corporation, better known as Farmer Mac. And we have Visa, as well as S&P Global, Prudential Financial, MetLife, and Old Republic International. So those are the financials on my watch list. As you see, each one of those has different focuses between banks, credit, insurance, and financial data. Then moving on to healthcare, we have 3 companies on our watch list from healthcare. We have Johnson & Johnson, Medtronic, and Abbott Laboratories. For industrials, we have Waste Management, Centus Corporation, Caterpillar, Fastenal, and Cummins. For real estate or the REITs, we have Realty Income. And for technology, we have 3 holdings that we're looking at on our watch list. First one is Broadridge Financial Solutions, Texas Instruments, and Automatic Data Processing, better known as ADP. Those, again, should be familiar, but one that may not be so much is Broadridge Financial. And they are an information services company. What their main focus is all the paperwork and all the behind-the-scenes stuff when it comes to public companies. So your proxy votes, your voting mailers, your annual reports, all the things that you receive from the companies you hold from your brokerage, Broadridge probably has a hand in that. So they're very intertwined with all the financial markets, and they provide a lot of the back office type of things that you don't really think about, but they happen on your account. So those are the companies on my watch list. As I said before, I will be adding some of these over time. And one of these in particular, I have decided to add to my portfolio. Again, we're going to be talking in depth on that in the next episode. So I'm going to take a few minutes just to go through the different columns just so everyone can take a look. If you're looking for ideas for yourself, moving over to the PE ratio for the company so everyone can see it. There are quite a few that have a lower PE than their historical PE, so that means it's potentially undervalued compared to its own historical numbers. And you can see which companies have a beta lower than the market or higher than the market. Remember, the market beta is 1. So you have some that are higher volatility than the market and some that are much lower. For instance, Procter & Gamble is only at 0.41, so it's less than half as volatile as the market, as opposed to things like Target is 1.24, so it's almost a 1/4% more volatile than the market. Total average return over the last 5 years. There's a few that have beaten the S&P 500. Over this time frame, the S&P 500 has been up about 15.7% on average for each of the last 5 years. So the ones in green are the ones that have actually beat out the S&P 500 over that time period. Then scrolling over more, just for everyone's reference, you have the dividends and the current dividend payout ratio, as well as the dividend yield compared to the 4-year historical dividend yield. Remember, if the current dividend yield is higher than the 4-year average, it does show that it's potentially undervalued, or they've increased their dividend, which then in turn increases the dividend yield. But either way, the ones in green are the ones that have a higher dividend yield, and they're potentially more undervalued than some others. Dividend growth is very important. This is a long-term portfolio, so you can see the 5-year dividend growth rates, and this is the annualized each year of the last 5 years. So things like Tractor Supply have done extremely high growth, as well as Cintas. You have some more that are in the 10 to 15% range. Then you have some that are 3, 4, 5, 6, 7% increases. While still good, it's going to beat inflation most years. It probably doesn't hit the chatter rule that we're looking for. So with that, the chatter rule, as you see at the end, the ones in green are the ones that meet the chatter rule requirements. The ones in the yellowish color mean they're very close to hitting the requirements. And then the other ones are well under the requirements. And then the total years of dividend growth, as I mentioned, are all important, and it does show the stability of the company. It's not my primary factor. All right, so there's my dividend watch list. I would love to see in the comments below which one you think I'm going to be adding to my portfolio next week based on the metrics that you see here. Again, I'm going to scroll back just to let everyone see again. All right, there we go. Hopefully you enjoyed that. Look forward to hearing in the comments which one you think I should add next. So there you go. As you can see, a well thought out watch list can be a dividend investor's best friend. It allows you to identify opportunities that you want to purchase in the future, allows you to track those particular companies in order to make informed decisions in the future, and it allows you to not have to worry about doing the individual research. As you have new money, you can just go back to your watch list and identify the stocks that are most interesting or most appealing to you at the time. Well, thank you for watching. Please subscribe if you haven't already, and make sure you follow along our series on how to build a dividend portfolio from scratch, where we'll be talking about which stock I picked to fund this watch list to add to that portfolio. Thanks again for watching, and remember, keep stockpiling those dividends.